Afternoon, everyone. My name is Brian Page. I'm here with Gary Forster, and we're going to go over a very interesting topic that's, I think, very salient to our state and even the nation right now. A lot of non-residents, non-citizens acquire real estate in the United States all the time, and so here are some our thoughts, some pitfalls, and what happens if things aren't structured the correct way. And if you have any questions during the presentation, please feel free to use the chat and let us know, and we'd like to answer them as we go. So that being said, I guess we will get started. This is our agenda today. We're going to go over some basic rules so you sort of have a foundation of taxation and why the structuring is so important when these parcels of real estate are acquired. We'll talk about the U.S. income tax rules, transfer taxes, mostly estate and gift. We'll do an overview of FIRPTA. We'll talk about the corporate inversion rules and why they apply potentially to how things are acquired. And then at the end, we will show some recommendations of what to do. First of all, how to structure it coming in if you can, but if not, a lot of times we're on the back end. How can we fix what's there?
This is a classic change in law that occurred in 1980, which can be ameliorated. So basically, before 1980, if you're non-citizen, non-resident, you're not subject to capital gains tax. So before 1980, you could buy and sell IBM. You could sell any kind of intangible, including intangible stock that in a company that owns real estate in the U.S. at no capital gains. So what happened in 1980 is part of a budgetary reconciliation, which included a lot of other law. The Congress tried to develop some more income from foreign nationals and created an exception to the rule that a foreign national, also a foreign resident, could sell stock in a real estate company and not pay capital gains. So FIRPTA is the income tax side of that eliminates that benefit. And then just as importantly, is the estate tax side of foreigners owning real estate, which we'll also cover, both of which are fairly easily ameliorated. You could totally avoid those taxes, but you have to do it on the way in, which is probably not done in about 80%, from what we've seen, about 80%, right, of foreign people coming into the U.S.
And especially on the estate side, if it's not structured the correct way, it's terrible outcome, disaster. And we'll talk about that. Okay, so basic rules. Obviously, all U.S. persons are subject to federal income tax to their worldwide assets, wherever derived. And that's for all U.S. citizens, green card holders, and if you fit under the substantial presence test, which we'll talk about here in a little bit. But it's important because, once a person's here and they're in the U.S. and they have residency, you have the ability to plan things domestically, set things up, and the techniques that are used are going to be different than they're going to be if you're a non-resident, non-citizen. And, you get into the estate and the gift side, but also the asset protection side, putting things into an entity a lot of times to protect it. And that's all well and good, but if you're a non-resident, non-citizen, and you use a domestic entity, then you're going to have a big problem.
Yeah. For some reason, there's the idea among much of the realty community, a lot of the financial planning community, that when a non-resident, non-citizen purchases U.S. real property, that it should just go into maybe a Florida or a Delaware LLC, and that's kind of the end of the story. unfortunately, we're now handling the income here, but on the income tax and on the estate side, that could not be further from the truth. So you have to be careful with the idea of the fact that the rules completely shift when you're dealing with foreign people. And you have to keep in mind, not only do the rules shift, but avoiding the tax requires a completely different strategy. It's not very complicated, actually, but it's a completely different strategy that for some reason 95% of the people dealing with foreign individuals don't understand.
And the consequence of not having it structured the correct way, on the income tax side, I mean, if you're deriving the income from things, it's not really going to change because it's U.S. source. But on the estate side and gift side, it is drastically different.
And it could change under certain circumstances. It can, on the sale of the real estate, it can substantially change it. Actually, I can go through that in terms of the planning. But the passive income side, the rents, the income, it's taxed at a different rate, but it's harder to avoid. It's the sale and the estate that really nip people. Brian and I were actually discussing something the IRS hasn't done, which is kind of marking a property. We're not sure how they would lien it, but you know, they haven't hired us to do it. We probably figured out, not that I want to, but basically when a foreigner comes in, if a real property is foreign owned, or if the real estate is held by an entity that owns mostly real estate, that property really, if I were the IRS, I would somehow mark or lien that property because of the estate tax. Keep that in mind, because of the estate tax, which is 40% of the value of that property. You could lien that property up and require payment before that property could ever be sold to anyone. Keep that in mind as we go through it.
Then we talked about, very briefly, a lot of times people forget the substantial presence test, and that can apply. It's an average. Basically, if you're in the country for 183 days within that 3-year period, and then within that time frame, you're within the United States for the year in question, at least 31 days, you're pulled in on the income tax side. So just keep that in mind. And,
interestingly, most foreign people who spend any time here, they're not totally aware of the substantial presence test, but they are aware of the cocktail party rule. The cocktail party rule is the 120 days. So if the cocktail party rule is, if I'm not here 120 days, I'm not a resident, right? So what happens is, if you're not a resident, the worldwide scope of income tax in the U.S. doesn't affect you. The 120 days is based upon this weighted average idea. So if they keep it under 120, the average never comes out to more than half the year. But as you'll see, that 120 days is totally irrelevant with respect to the estate and gift tax, which almost none of the foreign individuals understand.
Yeah, right. I mean,
till you're blue in the face, like they'll say, no, but I wasn't here 100. So Grammy, she had the 6 million in real estate, or she had the whatever, but I'm not a resident. Oh no, and she was a resident, so the 20 million in Brazil is taxed because she was a resident for estate tax purposes. It's got nothing to do with 120-day rule.
Right. The tests are different, and you can have vice versa. You can be a resident for estate and gift and not be for income tax,
or vice versa.
Yeah, right. And so, there's a lot of these rules because one's in subtitle A of the code, one's in B, and the rules are different. And a lot of times they seem to be convoluted with individuals. They don't understand them. And especially on the estate side, it's totally, it's bad. If you're a non-resident, non-citizen, and you own U.S. real estate and you die, it's not good tax-wise because of the small credit amount that they have. Now, for non-resident aliens, which are, non-resident, like citizens, the rules are obviously different. On the income tax side, you have the U.S. source of income. You've got to worry about that. You've got FIRPTA, those types of things. Now, what's interesting is there's a big exception for intangibles, for their sale. You think of stocks, entities that are owned, that are, closely held. Those aren't taxed on the income tax side. And so that is a way that we want to encourage investment in the United States, which is great. But if you die with these things and you're a non-resident, non-citizen, you're exposed to the estate tax. Now, you can gift them, but you can't die with them.
You can sell or gift intangibles.
Right.
Right, but you can't die with them. However, as I think it's the next slide, it's going to say, well, look, real estate's different.
Yeah, real estate's different. And that's really where, on the bottom there, it's defined as a United States real property interest, or a U.S. RPI, that's the parlance. And we have a special rule for that, and it's in section 897, and it's basically FIRPTA. And what happens is if you dispose of one of these interests via the land itself, or if it's in an entity, you're going to be exposed to this backup withholding.
The exception, so it's the exception to the exception.
Right.
All we need is one more exception. I like three, the exception to the exception to the exception. So foreigners pay no, I said foreigners, but people who don't live here and are not a citizen here, pay no capital gains. That's, first of all, when I say that to most people, they're, huh? Yeah, foreigners pay no capital gains, it's true. And then, but the problem is that rule doesn't apply if they take an LLC and they buy a house. Now it applies. Now it's not capital gains rates either. It's a graduate rate. It's a little higher in general rate. So the exception where they don't pay capital gains goes away if it's real estate.
And then the individual that sells the property, they have to worry about withholding the amount, because then they're responsible under FIRPTA. So that's also something that to be aware of.
Or the title company.
Title company, right. So what is a U.S. RMPI? Well, if it's real estate or any entity that's established in the United States and is considered a holding corporation, it owns something that's real estate, after 1980, you have a U.S. RMPI. And that's basically what it is. And so,
and it could be a chain of them. It doesn't matter how far out you get.
Right. And so basically any domestic entity that owns real estate in the United States is probably going to qualify under this URPI rule. So it's important. So this is the exception to the exception of the intangible sale for capital gains. It's important that these rules, this idea of 50% of the fair market value. For the the entity itself, what's in there. So that's an analysis that needs to occur. But basically, most individuals segregate things into so you have a parcel of real estate or an investment property in an LLC, and it might be under a holding company, it might be under some kind of structure. But if it's in the chain and it's sold, it's a U.S. RMPI. And you need to be aware of these rules and what happens if it's sold, and also if it's gifted, if a person dies with it. All these things apply for all of our non-resident, non-citizens.
Yeah, and so we're starting to get into the slides where, think about the trap now. So you have 80 or 90% of non-citizens who want to invest in the U.S. take no action to plan, right? It's just
the way it is.
We're loaded down with work, but we should have twice the work based on the volume of people investing here. They don't plan at all. Sometimes we get a call. Mom and dad bought a big house. you know, in Boca or in whatever
Naples.
celebration, Naples, yeah, a lot of Naples. Mom died. So now you get into this situation, well, but the realtor said to buy it in LLC, it would be okay. No, so they bought it in a Florida LLC, mom died, and the rule is that now half the value of the $6 million mansion is taxable, total waste of money. So what was it? So 6 million, 3 million times 4, $1.2 million. That's the tax, guys.
Minus
1.2.
minus the $60,000 credit.
You do get $60,000. $1.14 million to the IRS for no reason.
Zero reason.
So you have to do a little planning. I have had billionaires that won't spend a few $1,000s on a foreign entity. We can only guide. We can only bring the horse to the water. Sometimes the water doesn't get, you know. So in that case, we actually had that just occur. In that case, if they would have come in, created a foreign entity, bought the house, either in the foreign entity or in a Florida LLC owned by the foreign entity, no tax. Foreign entity doesn't die. It breaks the connection to the foreign family, and there's no tax.
It's so basic, but
It's so basic.
No,
It's so easy. It's so easy. So you have two hurdles, because I know we have I think only 30 or 40 people online, but we have several lawyers and tax accountants. When we break the barrier, there's two psychological barriers to creating a foreign. One is they have to come in to want any advice at all, which most people don't come in at all. And then next, they have to pay a few $1,000s to create the foreign entity to purchase the mansion. Now, a lot of people have no interest in paying a few $1,000s to do that. So at that point, the risk is if one or both owners die, it's 40% of the value of the property. And then, of course, you know, a lot of times, we were talking about that lien, but a lot of times someone will die and they won't pay, and then it will get picked up later. And then you might as well just throw the property away. If you do a lot of tax work, the penalties and interest accrue so quickly. And now rates are rising, so they can charge you even higher rate, that it just eats up the value of the whole property. It's a completely ridiculous situation that no one should be in. Interestingly, on the foreign entity, it doesn't come up that much, but it's good for the practitioners who are attending to understand. It's not just a shelter from the estate tax. You still have the FIRPTA. If they sell the property, still have FIRPTA tax on the gain. Okay, but we've had mostly South American situations. We had some developers come in where they acquire the property and they can do it in a foreign entity. The foreign entity owns a Florida or Delaware, which acquires and develops property. Well, they can sell the foreign entity at no tax. It's a strategy that it's not applicable to all the investors because they won't be able to sell the foreign entity. There's it depends. So if they have a foreign buyer, a lot of times the foreign buyer will buy the foreign entity. Or if they have a very sophisticated U.S. buyer, they'll buy the foreign entity. Typically there'll be a discount because there's some built-in gains in that foreign entity that have to be accounted for, but you can do better than you would have done selling the property. That foreign entity is not just an estate tax blocker. You can sell that foreign entity at no tax if you're a non-resident, non-citizen. It's just something to keep in mind. We did that one. Well, we've done a number of times, but we had one big one. I think it was before Brian. I was still a young buck. It was a piece of property that went from Palm Beach, the sand, to the intercoast, all the way to the intercoast, and there was a mansion on the front. And some of those properties, interestingly enough, they had a little tunnel.
Really?
Yeah, so you don't have to go with the riffraff. And they have a little tunnel from the mansion. It goes underground and up into the, anyway, it's outrageous amount of money. We sold that entity. We sold the entity and they paid no tax on that gain. Anyway,
We have a question, Gary.
we do.
We do.
Outstanding.
Yeah, so if an LLC owns a building, I guess that's in Mass, owned 98% by the non-resident, non-citizen, and the other 2% is owned by a resident adult child, and the LLC sells the building, will the non-resident, non-citizen owe tax on the gain?
Well, you have to break it down as to what is a US RPI. If the US RPI has mostly real estate, right, that's the holdings of the US RPI. And then what's a US RPI element in terms of percentage ownership? I think it's 50%.
Yeah.
Yeah, I think it's 50%. So that'd be a US RPI. So that will be subject to the FIRPTA.
Yeah. Now, I mean, you have to withhold it, and of course, it's a disposition, so that's why it's the exception to the exception.
When you sell a property.
Right.
And if you don't layer in a foreign entity, we're going to go into that now. But if you don't layer in a foreign entity between, it's a great question, by the way. We also had this to just come up. There's an answer, by the way. It's a cool kind of answer. If you don't layer in a foreign entity between the property or the US RPI and the foreigner, you'll have the estate tax, which is really brutal.
And then, of course, there's a follow-up.
It's the same as our
Yeah.
last time. Yeah, we
Yeah,
just
yeah,
had this
yeah,
come
yeah,
up.
it just
Large
came up.
estate issue.
Is it better for the foreigner to acquire the U.S. real estate by a foreign entity than a U.S. corporation or a U.S. LLC? Yes.
That's the answer.
That's the answer.
You have to do it. It's the only way to do it.
Right. And if you advise otherwise, that's probably not practice. Sure. They ask you, it's very basic, but you set it up the right way.
And if they don't do it, if they don't want it, we always have to write a letter. If you don't do it, because you're just setting yourself up for disaster. And I got to tell you, there's probably 25,000 properties in Kissimmee that are owned directly by foreign. I mean, it's crazy. It's totally crazy.
Okay. Now we talked about the income tax. So now we're going to talk about this is going to be fast. Just the basic estate. If you're, obviously, if you're a U.S. resident, a citizen, the estate tax, gift tax, GST tax, your worldwide assets. It's very straightforward. It's very basic. Now, if you're a green card holder, you be careful because the green card is for income tax. On the estate gift side, the test is different, and it's all about domicile. It's your intent and where you reside. So it's possible to be an income tax resident, but not an estate and gift tax resident, and you can plan accordingly.
Yeah, it's great sometimes that they are completely different tests.
And especially if they have non-U.S. based assets, if they're outside the U.S., domiciled outside the U.S. for estate and gift, they can gift those away, and there's no gift or estate tax on those during their lifetime. I mean, because they're out. And if they die, they're not domiciled here. Their worldwide assets not in the U.S. aren't pulled into the estate tax.
As long as they're not in the U.S.
Right.
And the way you make the U.S. stuff not in the U.S. is to own them through a foreign entity. Send the questions in if you like. That's what you have to do, guys. You have to do it. And for the realtors on the line, if you don't do that, all the realtors, all the financial people, all the CPAs should have a little letter that says, we understand you may be buying U.S. real property. You may be characterized as a U.S. real property interest. We recommend you contact your tax attorney. You could be, in all likelihood, he'll have to acquire the interest in a foreign entity. Please see whatever they have the information over. We understand that a lot of realtors are reluctant to get in the way of any of these sales. But we've always recommended that at least a letter making the client aware of the fact that they need to do a little planning before they acquire anything is hugely helpful. It's hugely helpful to alert people of the issue.
Right. And so, and why is this important? Well, I mean, if you're a U.S. resident for estate and gift, then you get a $12 million exemption, unified credit amount, which is, is a lot.
If you're a resident.
If you're resident, and you're also able to gift $16,000 a year per individual. So it's important to know, you got to be able to, the classification is very important, and it opens up different options for planning.
So if it's a push and pull. If most of your assets are in the U.S., right, and you haven't properly planned, you may want to be a resident to get the exemption of $12 million. If most of your assets are outside the U.S., right, you don't want to pull them into the U.S. and subject them to U.S. estate tax when you die by being a resident. So that's the kind of push and pull. It depends on where you want to be and where your assets are.
Right. It's all fact-based, and it's circumstances. And that's why it's important to go through. That's why they should meet with someone to plan what to do. Because it depends.
It's a pretty bright line, though. If you plan right, you really can avoid the tax.
Right, I agree. Now, for non-resident, non-citizens, here we say just non-resident aliens, they're only subject to U.S. estate tax on U.S.-based assets, but their exemption amount, their credit is only $60,000, and it's not indexed. It's been $60,000 for a long time.
It's essentially nothing.
It's essentially nothing. And when you have real estate, especially right now, I mean, everything is millions of dollars. I mean,
and how many times Dad died, and they said, "Well, no, that's okay. My whatever. My tax advisor said, no, the tax is incurred upon the second to die, like with U.S. residents.
There's no marital deduction.
There's no marital deduction. They just take half the value.
Half the value with the $60,000 off. That's it.
It's brutal. It's totally brutal.
Now, it's interesting, you were able to gift U.S. intangibles to gift tax-free during life, but you can't die with them. If you die with them, it's pulled into your state because it's U.S. based.
And then I think that's the next slide.
The
question becomes, who do you give them to?
Right, yeah, we'll get into that. And so that's the overview on the estate tax side, estate and gift. It's pretty basic, but just these are all these foundational things you need to understand to properly plan for your clients. Now, what is FIRPTA? Well, as Gary explained earlier, we're gonna go through this pretty fast, but basically Congress decided that, that U.S. real estate's different when it comes to either how it's owned, how it's disposed of, when it relates to capital gains, be it individually or in an entity. And so they impose this tax, and it's for any disposition. And what that means is, something that there's a gain or loss. It does not apply to gifts. I'm going to talk about that, at least as relates to the withholding of tax. Now the estate tax rules are different. FIRPTA is income tax, so you have to divide the two. But understand that is how it works, and you can find these rules. I list the code there if you're interested. But basically, if you dispose of a U.S. RMPI, this is going to apply.
That's meaning the actual real estate or a company, a U.S. company that holds real estate. It's what they do is they say the exception to capital gains for foreigners doesn't apply, and what we're going to do is we're going to treat it like a U.S. business. U.S. business.
So, to avoid, FIRPTA, they try to say, oh, well, we'll put an entity in between, the non-resident, non-citizen and in the real estate, as a barrier. Well, they caught on to that and they said no. And that's why that we talked about if you have an entity, a domestic one, yeah. Right. And so if there's a disposition of the domestic entity, the equity, then this tax is also going to apply.
What's amazing is, these rules have not substantially changed since 1980. yet very few people are aware of them. And the withholding slightly changed. It was always 10%. So what happens is you get trapped in this situation where the title company has to keep 10% back of the whole revenue, or the whole sale price. If it's under $1 million, over $1 million is 15%. That's a new rule, by the way, 15%. And then the foreign individual has to file a U.S. income tax return for that year, and then they get the money back if the gain is less than that. There used to be a process where if your gain was minimal, you could get a certificate. We used to do used to do those all the time. I'm talking about a long time ago. It became very cumbersome, and you could get it in like one day via fax. I found though that, in the early 2000s, really it became very difficult to deal with. And if you have significant property in the US, you're going to need at least 2 months to deal with that certificate. And if not, it's no big deal. You make sure you have a good withholding agent, and you file your return, and you get the money back.
We have another question. It says here, someone asked me, asked us, establish a U.S. LLC that owns real estate in the U.S. Behind the U.S. LLC is a trust located in another country. Would that be taxable in the U.S.? Well, I mean, a foreign trust is a foreign entity.
That's right.
So it would be a break there, at least on the estate
It's
side.
taxable on the sale,
Right,
of the real estate or the U.S. LLC if you sell it. If the foreign trust is properly formed, we need a little more information in terms of who the founder was and who the beneficiaries are, because there's a whole body of law that will actually disregard that foreign trust as what's called grantor, just like invisible to the IRS. And that would not work. That would not work. But if it's foreign individuals, I might have missed that in that question, but if it's foreign individuals that properly create a foreign trust to hold the LLC in the US, that probably works. You won't have estate tax.
we have some other videos on our YouTube channel that discuss foreign trusts.
Yeah.
So please feel free after this to go check them out if you're interested.
Or call.
Call. Okay. We have one more. Someone says, I believe that the FIRPTA withholding didn't apply if the sales price was under $300,000. Is that still true? There is a de minimis exception to FIRPTA. I believe it's 300K.
It's 300, but
yeah,
the tricky part of the 300K is that it's residential, and that the buyer has to live there. Like, so you have to get this. Well, sometimes it's fine, but sometimes it's like, they're playing around with this, and it's, obviously it's foreign investment. So a lot of times it's really just investment property, rental, or whatever it is. And you have these buyers signing these affidavits, but they're not really going to live. They got to be really careful with that. But yeah, there's a $300,000.
Remember, it's the gross price, like, the gain.
That's right.
Keep that in mind. Okay. Now, what happens if someone already has acquired the U.S. real estate and it's in a domestic entity? What do? Well, we just talked about you can't die with it. We've established that. So most people are like, oh, we'll just create a foreign entity and put the U.S. entity underneath it as a sub, right? Or merge it in, or, whatever. Well, Congress thought of that too.
So later,
they
figured, yeah, well, you were still pretty young, but there was a period of time where you could just ameliorate the situation.
That was before my time.
And then they came up with this inversion, which is a disaster.
In this case, it is. I mean, it's designed for something else, but like everything else, when they overlay things on top of each other,
but they caught it. It was totally designed for big corporations moving headquarters out to take advantage of lower tax. But they caught it. They wrapped it into the thing. Yeah.
So I mean, if you have a client that's a non-resident, non-citizen who wants to do this, you have income tax rules now that cause bad reaction consequence if you do this, if you invert it, basically, which just means you try to put it underneath or you merge it with a foreign entity. That's why it's so important to plan it initially and then acquire the real estate. You can't do it after the fact, because if you do, then you're going to have an inversion. So what is an inversion? Well, if it converts to, merges with, or makes a domestic entity a sub of a foreign entity.
In other words, you're moving your property offshore. You hold it individually or you hold it in a U.S. LLC or corp, and you don't like that because if you die, it's 40% of the value is tax. You want to move it offshore. That's an inversion. Essentially, that's an inversion.
It is. And why is that important? Well, in the next slide, I'm going to show you. It's compact. There's a lot of information, but it basically explains what it is. And I apologize, but I want to make sure you understand what the rules are. So you're going to see it here. So there are two types of inversions, and what happens? There's this 60% one, and there's an 81. And their outcomes are different depending on the type of inversion. But an inversion in general is you have a foreign entity that acquires either directly or indirectly substantially all the properties held by a domestic U.S.-based entity. That's one. Two is 60% of the equity, the stock or the votes, will be held by the same owners as the domestic one that is being taken underneath or merged. And then, they don't meet the substantial business activities test.
Yeah, if you're actually moving and you are going to do business in this entity, that's different.
Right.
If you're just trying to avoid tax, that's what we're worried about here.
Like a holding company.
The 60% basically triggers gain.
Right, exactly. And that's basically what it does. The next slide triggers gain.
And you can't, and then what they do is they nip you, because if you have any losses or anything else, you can't carry forward certain what they consider tax benefits. It's really kind of a disaster. But it's not as bad as the next one.
The next one's even worse, which is what most of them are going to be. They're going to be
Yeah.
80% or over, because the same people are just trying to get it out.
Exactly.
So on the 80% side, if 80% or more of the foreign entity is held by the new owners who basically owned it before, then you're going to, this entity, first off, it's going to be tainted from then on. Even though it's outside the United States, the U.S. is going to deem it a domestic corporation. That's it. And so if you die with it, guess what? It's still going to be includable in your taxable estate. And it's forever tainted. Bad.
Yeah, the idea was you had a big U.S. company and you moved to Ireland to reduce your income taxes through having a base in Ireland. And they said, no, we're just going to call the Irish company U.S. So you can't do that. But then they applied it to like these small, real estate companies. But it's almost like an accident. But they did it because you're trapped. If you don't plan to begin with, you get trapped, and now you're trapped, and the whole Brazilian family just ignores it until like somebody dies with 25 office buildings, and then it's a 2-year consolidation, and $25 million in tax. So we see that all the time.
Yeah. And the other thing is on the income tax side, you're going to be taxed likely in the foreign jurisdiction and in the U.S. because you're a domestic corporation for the U.S. So you have double taxation.
Yeah, it's a twisted little situation. Yeah.
So you want to avoid that that's bad. So that's why, so if it's already in a U.S. domestic entity, you can't do an inversion. That's basically the rule. You can't just put it underneath like you normally would do with a holding company that's outside of the U.S. So we're going to talk about how to plan initially and then what to do if you're in this situation. This next part of our slides here. So first off, we've already talked about it. What do? You form a foreign entity first, then you acquire.
Every time.
Basic.
Every time.
And this will allow your non-resident, non-citizen clients to avoid the estate tax if they die. Every time. So that's how it ought to be done. If you
By
start,
the way, I think there are some CPAs who don't do it either. I mean, because it also creates a lot of legal and accounting work if you don't do the foreign entity. You know what I mean? I mean, I hate to say there's malice out there, but there's malice out there. You need to create the foreign entity. And that foreign entity should be planned into the existing structure of the family, wherever they live. And that entity acquires its US stuff, and it doesn't, and it totally avoids any estate and gift. And there's a possibility you can actually sell the foreign entity at no US FIRPTA tax. It's a completely necessary element. It's very uncommon that wouldn't be required.
agreed. So that's the basic rule. Now, what do you do after the fact? Well, we have some examples here of what you can and can't do, and what are some of the consequences. If the non-resident alien has already acquired the U.S. individually, the property individually, what do? Well, they could do a transfer to a foreign entity, but that's a disposition, and FIRPTA is going to apply. So that's one option.
That's so you have to pay tax on it.
Right, pay tax on the gain. The other is if you have a person in the United States, family member or something, you could gift it, but we wouldn't recommend that, because if you gift the property outright, it's not intangible, and you're going to pay gift tax, and you only get a $60,000 credit. So if you wanted to gift it, we would recommend you put it in a domestic entity, and then gift the domestic entity.
The intangible is not subject to the gift tax, but what Brian's saying is that if you gift it, you can gift it to a foreign person, but then they end up in the same situation. So we have had situations where, like, grandpa gives it to grandchild. So you're buying time. So there's a grandpa died, and they have a 40% estate tax, so they gift it to the grandchild. And so you can buy some time. Well, you think you buy time, you plan to buy time, but that doesn't really solve the problem, because if the grandchild's foreign, it's going to be subject to the same 40% tax when the grandchild goes, unless we continue this weirdo gifting scenario while the property increases in value and the estate tax goes up. So the idea is, and we just had this where we've got a kid or a grandkid who's a U.S. resident, and they can take advantage of the $12 million exemption. So it is an option.
And there's different, and there are things that we're able to leverage the credit amount as well domestically. Different techniques.
Yes.
So it's not a dollar for dollar. I mean, it's going to be
more than 12.
Right. So it's going to be more than 12. So that's definitely something that's there. So that's if they have it individually. Now, if they acquire it or they move it into a U.S. entity, and you want to avoid the estate tax, what do? Well, first off, you have to avoid the inversion rules. We talked about that. That can't be done. So as we discussed, you can gift the domestic equity and that the entity that owns the U.S. RMPI, and the FIRPTA won't apply to the gift. And if they're non-resident, non-citizen, it's intangible, there's no gift tax. So
That's a transferor. It's not
Right.
resident, so
Right.
there's no gift tax, exactly. But you'd rather do that to a U.S. resident.
right, because if like he said before, like Gary said, if you give it to another non-resident, non-citizen, you're just buying time. That's it. But I mean, I guess it's better than nothing. But so that's one of the things. And then lastly, probably the best way to deal with it will be the sale of the equity to a new foreign corporation.
Mm-hmm.
And that's how you get it out. If you're already in this scenario, that's how you get it out. Really the only way to get it out.
Well, if there's not a lot of gain, that's a pretty good option.
Yeah, it is. And it's a clean break. It's reported to the IRS, and then thereafter the foreign entity owns it, and there's the break.
There's never any estate tax again.
Right. So that's really the answer to that question beyond the gift.
Yeah, so you set up the foreign entity, you go through the FIRPTA transaction and, it's like internally, just related parties. You get an appraisal, and the appraisal says there's X amount of gain. If it's small, it works out great. You pay that money in. You go through the withholding if you have to, and then you're done. It's outside the US, the family can move on, integrate that foreign entity into their current structure, and never have to worry about, this generation died or that generation died, or what are we going to do because the property is worth a fortune now. We can't, it becomes a huge built-in gain issue. That's a pretty good option. Actually, I really like that option, to be honest with you, rather than the gifting to the generation.
I think it's better. And then, of course, you're also going to get a fair market value basis,
Right.
Because you bought it for the fair market value. So that's, we believe, we recommend that's probably the best option.
If you have any questions, you can just call us. Do we have any more slides?
We have one more slide, but just we have some questions.
Oh, we
so
do?
Let's tackle these.
I can't see them.
Yeah, I'll read them. So someone wrote, according to the U.S. tax rules, a U.S. corporation or LLC could not change its fiscal address domicile to a foreign country. This situation.
Well, there's some different issues there. Fiscal domicile and address are totally different. Okay, you can have the address wherever you want. You can get your mail wherever you want. You can have headquarters wherever you want. It's still a U.S. entity. It's where it's formed. That's the basis for state tax. That's actually one of the problems on the treaty side, which is beyond this seminar, but it's where it's formed. So the issue is the same issue legally. So if you want to change the corporate seat of the entity, you are moving the entity outside the country, right? Which creates a foreign entity, which is an inversion. And that, depending on the circumstances, you trigger gain and you don't get your tax benefits on the 60%, or you go into this 80% scenario where it's still, even though you change the corporate seat, it's still treated as a U.S. entity. Better is to do one of these amelioratory resolutions whereby you sell it if there's not a lot of gain, you can gift it to a later generation, but you kind of want to avoid these transfers where it inverts the corporate seat. Not only does it create this taxable advantage at 60 or 80%, but it creates a lot of complexity. So I probably would just avoid like these quick, what I call silver bullet answers. Well, we're just going to change the corporate seat, or we had somebody come, we're just going to file this deed, or we're just going to. The idea is, before you acquire, let's set up the structure so you don't have to worry about it afterwards. And then if you're stuck in a situation, you can be, this situation combines with a lot of other situations too. We have currently there's several of these, but we have a big one where, for instance, we do have a U.S. grandkid, and we'll probably use the U.S. grandkid, etc. But a lot of times people are here for a period of time and they're leaving and they want to sell. That creates another expatriation issue. So advise the client to just spend a couple hours of time with a competent tax attorney who does a lot of international work and get a little structure together. And then at least they'll know what to do. If they decide that it's worth risking $14 million for $4,200, then they take the chance. I know that sounds hilarious, but it actually goes on every day. We still find it hilarious. It's still hilarious. But at least they spend a little bit of time, a tiny bit of money to understand where they're at, whether they want to hear it or not. And then we can ameliorate it. Sometimes it comes out, that one with the Brazil came out a lot. The actual cost wasn't bad. Wasn't a lot of cost to get
made it that big exposure.
Oh, it was pages of assets. Yeah. So That's the answer. You don't want to shift the corporate seat like that.
We have more messages. Great. Well, we have time for one more.
Okay.
So if the non-resident, non-citizen that owns the real estate has a will where the property is inherited by a child, also a non-resident, non-citizen, when the NRNC died, does the rule change because there is a will, or does it make any difference?
No, it doesn't.
No, it's where so even if you're a non-resident, non-citizen, you own U.S. real estate and you die, or you own a domestic entity that owns U.S. real estate and you die, that value is going to be pulled into the gross estate.
It's kind of sad when we see people come into the U.S. and they go to an estate planner and they spend money on a revocable trust or a will, and they come in and they were told that they're all set.
I mean, even a life estate deed would be the same. It's still in transfer.
Doesn't matter.
Doesn't matter.
It doesn't matter. It's the value, and that value has to be shifted offshore. Once the value is shifted offshore into a foreign entity, you're okay. These kind of silly moves with this U.S. revocable trust and oh, I'm just going to put it into a Florida LLC kind of thing, do not solve it.
And so if they die with it and they own it, it's going to be taxed. It's in the U.S. That's the bottom line if you're a non-resident, non-citizen, because it deals with real estate and the situs is here. That's why you need that foreign entity that makes the break.
That's it.
That's the answer. Okay, I think that's all the time we have for today.
Yeah, thanks so much for attending.
If you have any other further questions, please
The
email
next
us.
slide, I think, will be the emails and stuff.
Yeah, let me just get there.
There you go. Yeah.
I do see one more question here.
Okay.
It says, would you advise an NRA to purchase even a primary home in this structure?
Well, it won't be a primary home if it's an NRA. Because a primary home requires that they're a resident, right? So it'd be an investment property. And the answer is we always, pretty much always advise, if you're not a resident and you do not have a U.S. passport, to buy all U.S. property in a foreign entity, because it avoids the problems.
Right. And if your situation does change and you do become a U.S. resident, then we can
dissolve it.
We can dissolve it if need be, but in the meantime, you have this barrier.
It doesn't hurt.
It doesn't hurt anything. So,
Thanks so much.
thank you so much.